Nvidia reported their earnings yesterday after the bell, and there was a sharp drop-off in the stock price that has since then already pretty much recouped all of its losses. In this video, I'll be going over what happened with the Nvidia earnings report, why it matters to the rest of the market, and perhaps some stocks to watch for the rest of this week, and whether or not this could lead to a further melt up in AI stocks, or if this is signaling we are closer to the end of this AI rally. Let's jump in. Welcome back to the channel, guys. Yesterday, we saw a move from kind of its peak yesterday, at one point down 6% or so in the after hours trading that took place around the earnings report for Nvidia. But as the stock market opens up here today, I'm recording this at 9:30 a.m. And the stock market is just opened up, and we can actually see the stock has completely recouped off all of its losses, which is pretty impressive and just a testament to how loved this stock truly is. Taking a look at the earnings report, let's track it using the earnings report tracker available in the stock box. So if we just take a look really quick at the latest filed data, what we can see here is that the earnings per share did beat expectations by about 4%, which came in at $1.05 per share compared to the estimate of $1.01. This follows a string of examples in which case Nvidia earnings actually beat estimates nice and steady. This is part of the reason why the stock has done so well. It keeps growing even more than people think it's going to grow. But one thing I want to draw your attention to is this secondary chart here below. This is the earnings surprise meter that we've built here to help better track earnings reports, which shows you the surprise at which how much the earnings have beat or missed expectations. And you can see we've had 5.6%, 8.5%, 5.25%, 8% beats, and then we have this reported number, which is noticeably the lowest beat that we've had in a while in terms of earnings per share. And so the reason I bring this up is that may have been just showing you how hyped up the stock was going into earnings. The stock price has been on a tear to the upside. It's doubled since the April lows. And so expectations are really high. And so to come in with a beat that doesn't necessarily beat as much as it had recently been doing just shows you how hyped up this stock really is. Now, let me reiterate, it's hyped up for a good reason. The stock has some incredible revenue growth and net income growth, and I'm a shareholder myself. In fact, here is a look at my current position on Nvidia, and I want to just break this down really quick. So what we've got here is my Nvidia shares. I have 500 shares long on the stock, which are up really nicely over the last few months. I did buy this during the April sell-off. My average share price is $111 on Nvidia. But I also did an earnings play where I shorted calls at the 210 strike price, and these calls are now nicely, they've lost some value, right? When you're selling calls, you want the calls to lose value. If you're buying calls, you want calls to be in the money and to make huge returns. But I like to sell options, and in this case, I had a covered call position going into Nvidia's earnings report, capitalizing on what I believe to be limited upside on a stock that I believe is a great company that has also gotten a little stretched in recent times since those April lows. So I sold calls essentially out of the money at the 210 strike price. And now those calls that I sold are looking nice because, again, the covered call position has kind of worked out here. And as I mentioned in my previous video, going forward, I am definitely going to read this more often because that does so much better than me trying to explain it on the fly. I'm going to explain a covered call through AI overview from Google here. So a covered call is an options trading strategy where you own shares of a stock. As I just showed you, I own 500 shares, and you also sell a call option, which is a bullish bet. You're selling a bullish bet. So it's kind of a neutral to bearish strategy against those shares, giving someone else the right to buy your stock at a specific price, at the strike price, before a set date or the expiration date. This strategy is used to generate income from the options premium received and can provide some downside protection. Here's an updated look at Nvidia share price. You can see it just jumped on the open and has now kind of come back. I'll be curious to see how this looks on an intraday chart at the end of the day, but generally I am more interested in kind of the bigger term move. And the stock price still looks really, really strong. I do think there is room for Nvidia to maybe come back and retest a little bit. Again, it still beat its earnings, but it didn't beat as much as, it recently has been beating, right? The stock has very high expectations. And so when you have incredibly high expectations for a stock to deliver, even a mild, disappointment can cause a correction in the stock price. That's why I sold the covered call and why I believe that the path of least resistance for Nvidia is to either consolidate sideways or to even pull back a little bit, at which point I'll remain a shareholder. I love this company for the long term. I think it has a lot of potential to continue being a massive generator of wealth. for investors. But at the same time, there is also times to kind of recognize that a stock might be a little bit short-term overextended. Today's video is sponsored by Moomoo. And if you haven't heard of Moomoo before, they're a one-stop global trading platform with over 26 million users across the US, Australia, Singapore, Canada, Malaysia, and Japan. And Moomoo offers $0 commissions on stocks, ETFs, and options trades. They also offer free level 2 data and real-time options chain data, no extra charge. And the Moomoo platform is super advanced. They offer a really powerful options trading tool, and you can even track latest public figures holdings like Nancy Pelosi's directly within their portal. And if you want to learn something about a particular stock, just ask Moomoo's AI feature. With this tool, you can ask for trading insights on your favorite stocks. And if you want to tap into what institutions are buying and selling, check out their institutional tracker. This tool allows you to explore top institutional holdings. What sets Moomoo apart is their incredible platform for researching stocks, checking out all sorts of different analyst rating tools, and insider holdings and trades. And for a limited time, as shown on the dates on the screen right now, you can get up to $1,000 in Nvidia shares, plus 8.1% APY for US users. As you can see on the screen, please follow the criteria here and make sure to use the link in the description to get the full context behind this offer while it is available. It is available for only a limited time. And are you already trading with another brokerage, but all these tools sound pretty cool? Well, I think so too. And they're currently offering a really cool 3% match on the first $1 up to $20,000 transferred from another brokerage. So if you're looking to take your trading tools to the next level, check out Moomoo and take advantage of some of the offers available using the link and details in the description of this video down below. Now back to the video. And Nvidia stock falls after the data center sales miss forecasts and the CEO calls Blackwell demand extraordinary. This guy, right, the CEO is, of course, he's a hype man, and for good reason. They build a really awesome product, and I think that Nvidia is helping to change the world. So I have a lot of respect for this guy. But I just want to add into it, of course, CEOs are always going to pump their stock. They're always going to kind of speak highly and optimistically about things. So you always kind of have to take it with a little bit of grain of salt because they are ultimately salespeople, right? They have to be. That's how you build a great business, is build it off the back of, strong sales and hype around your product. But I also wanted to mention this little component here because this was what a lot of people were looking at, was outlook on China, right? Because again, China is a huge marketplace for Nvidia sales, and kind of going into the sovereign sales, right? Selling to Saudi Arabia and selling to China opens Nvidia up for even more potential growth. And so this was where a lot of the hype, a lot of the excitement around the stock has been, is like, are we going to be able to see Nvidia selling shares big time? So the company has not assumed any H20 shipments to China in its outlook, and I think that partially plays a role as to why the stock sort of didn't move too much on the earnings report. Still, again, beating estimates on earnings and revenues, looks good overall, company's still growing, but that China outlook was really what could have gotten the stock to pop big or drop big if there was more disappointing news on that front. Here's an updated look at my Robinhood position, which a lot of people have been asking about or commenting on. So Robinhood is a company that I love for the long term as well, but in a similar situation to Nvidia, I have also sold out of the money call. Oh, I'm sorry, they were initially out of the money. They are now in the money calls. I sold a 98 strike price call on Robinhood, and so this call option, I did sell it, however, when price was towards its highs. So these calls are now nicely in profit from where I sold them, right? So even though the call, without getting too convoluted here, is in the money, I sold it at a much higher premium than it's trading for today, which is resulting in a floating potential profit here of around $5,900. I also own 600 shares of Robinhood that I got at an average share price of around $40.21. And similar to Nvidia, again, this is a stock that I love for the long term. I think Robinhood will likely be a stock that I kind of hold exposure to for a suspended period of time. But it's also had an incredible run, and I do think it has room to consolidate sideways or even to pull back and still be, in my opinion, a great stock to hold for the long term. So to capitalize on what I believe to be a possible consolidation or even pullback phase, I have sold calls to collect income on the shares that I own. However, if the stock price were to dip and give a substantial discount, I would definitely think that there is some opportunity to pick up shares at better prices and to buy for the longer term. Here's a little bit of an update on what I've been doing with my Tesla position. So some of you guys know I've been holding some Tesla shares for some time and have sold the $355 strike price calls as well as the $400 strike price calls. Those expire the 19th of September, and those $355 calls look like they're getting tested here pretty soon. They're not quite in the money, but they're pretty close. So I did sell calls. I do still love this company for the longer term as well, but have been very much okay with the idea of reducing my exposure a little bit to Tesla through selling covered calls. And if I do get assigned and called away from these shares, right, because I would be required to sell the shares if the strike price, if price is above the strike price by expiration, I'd be required to sell 200 of my 400 shares. Now, if of course both of these are in the money, then I would have to sell my full position of 400 shares, which I'd be okay with. That would be a really nice profit overall on my Tesla trade that I've been in for the last few months. Here's another stock I've been watching and really like as well, which is Amazon. Amazon, nice push here to the upside. Still looks like it is very much trying to make a run back to these previous highs. I own a good bit of shares of Amazon. I've also got a covered call position on 200 shares. So I own these 60 that are just uncovered and then 200 that are covered as well. Path of least resistance for this stock to me looks sideways to up, and we'll see if we can continue in the general direction that we've been in since those April lows. Another stock that I'm keeping an eye on is Apple. And I saw something interesting about Apple wanting to potentially partner rather with Perplexity. And this concept of Perplexity has recently been a lot of the discussion around Apple stock. Should they buy Perplexity outright, or should they partner with Perplexity? Perplexity, of course, if you don't know what Perplexity is, it's this, of course, it's one of the many chat, large language model kind of AI stuff, right? And so a lot of these businesses like Microsoft is working really close with OpenAI. And so Apple's kind of found itself in the situation where the right move for the stock, the question is, should they just buy their way in? They have mountains of money that they're sitting on. The company is incredibly profitable and has so much cash on hand. Should they just go out and buy another business that's already ahead on AI? Perplexity is, again, arguably a very competitive product in that space to jumpstart and get their AI stuff going. I think if they did that, or maybe if there's a partnership that, you know, we could see, that kind of news would bode well for the stock. Because again, I think where the biggest concern for Apple shareholders is, at least from my kind of read on the subject, is that AI is something that they seem to be behind on. And so you have this product that everyone has in their pockets, or so many people have, iPhones and their smartphone devices, and Macintosh laptops and all that, right? And so everybody has these products. AI needs to be implemented into them, and Apple is in the position to really dominate on AI, but it's been frustrating to watch them kind of fall behind on that. But I do think that they are aware of this, and if you've trusted in Apple shares over the last many years, you've done really well. And so the question is, do you look at an Apple which has been, again, largely disliked on Wall Street for a while, and do you buy a dip if you get it in the stock? And part of the risk to reward profile in Apple, I think we can look at in the form of their financials. I pulled up the stock analyzer tab within the stock box to explore a little bit more about Apple's share. And so when we look at some of the financials, the PE ratio for Apple is definitely more on the expensive side of their 3-year average. The forward PE, however, looks okay. Price to sales looks a little bit high. Debt to equity also looks pretty good. Revenue growth looks okay. Earnings growth looks okay relative to recent years. Return on equity looks good. And so generally, I feel like at current levels, I don't love the idea of buying Apple shares. But if you got a pullback in the stock that makes the valuations a little bit more attractive, this could be a potential buy for me if we did get some pullback. And I've been featuring this in the videos recently, but the stock box has a really cool new feature. It's the top stocks indicator. And if you're familiar with my other channel, Trader Nick, where I talk mostly about indices, commodities, and currencies, at a more macro level, we have what is called the top setups page, which looks at gold and silver and the dollar and indices and all that. But the top stocks is essentially that, but built specifically for individual companies. companies. We check things like technical readings like momentum over extension. The algorithm, it also checks things like sentiment, like institutional buying and selling, analyst ratings, and it also looks at a wide range of financial readings: debt to equity, return on equity, price to free cash flow, forward PE, trailing 12-month PE, and much more. The top stocks indicator essentially shows you the overall scoring of the collected data that we have within the tool. You can see, for example, some of the stocks that it's picking right now are things like Johnson & Johnson, Amgen, Meta, Intuit, Amazon, First Solar, Abbott Laboratories, AMD. And so these are things that are getting higher scores. And so we can actually take a look at some of these reads, and this essentially creates a watch list. Also, I see my hood in here, which of course, you guys know I love me some hood. Johnson & Johnson was one that I was actually looking at, and as it pulls back, this may actually be a name that I like for picking up on the long side. Amgen is another big name in the healthcare world. It's a health technology or biotechnology company. I don't love the price action here, but it did make the watch list. And of course, a crowd favorite is AMD. Let's check that one out. AMD has a really strong overall upward trend and has pulled back into consolidation, finding nice support off of this area. If you got to dip back into this area, again, it kind of depends your macro outlook. I'm a little cautious on stocks in general right now, so I may be very selective, or if I took this trade, it would be a very small one. But to me, this stock actually looks potentially like it is poised to continue its momentum rally that we've had in recent months. Another stock on the watch list here that looks actually interesting to me is Dollar General, just from a interesting perspective in the sense that this is a stock that once was a absolute, darling on Wall Street. This thing was a monster performer and has completely fallen out of favor. I just wanted to bring this one up because I think it's interesting. You get some good variety in terms of the top stocks page. You have some value stocks, and you also have more on the tech stocks as well. So you get some momentum, you get things, but basically what this thing is looking at is it's looking at technical sentiment and financials to try and help gauge stocks that may have more room to the upside. At the end of the day, as a stock trader or investor, the primary goal should be to filter for the proper setups that have the most potential energy and the most attractive risk to reward. We never know exactly what's going to happen with companies or with stocks, individual level, but we can make educated guesses and we can look for opportunities that have good risk to reward. That is what the top stocks page ultimately aims to do. And if you want to try it out, I'll leave a link in the description down below.